Ladies and gentlemen, if you hear one warning today, this is that the gold to silver ratio is tearing apart the script, hurtling back toward 30 to 1. And many of you aren't even paying attention. The markets are screaming opportunity, and the world's investors are still asleep at the wheel. By the time most wake up, the move may already be behind them. This is not speculation. It is a structural shift already underway. Tonight, I want to walk you through the evidence, the catalysts, and the precise moments where you can act. Because when history shows the ratio collapsing like this, it often writes the biggest gains for those bold enough to move early. Every time markets forget history, they pay for it heavily. That's exactly what's happening again with the gold to silver ratio. People are looking at the numbers on their screens, 80 to 1, 90 to 1, sometimes even 100 to 1, and thinking that's normal. It's not. It's the symptom of a distorted financial world that's running on fake money, inflated assets, and emotional investing. Historically, that ratio has always found its way back to balance, back toward 30 to 1. And when it does, it doesn't move quietly. It moves violently, catching most people unprepared. You see, history has a rhythm. For centuries, gold and silver traded within a tight relationship. Back in ancient times, and even through much of the 19th century, it hovered near 15 or 16 to 1. That was considered fair value. Gold was money. Silver was money. They weren't just investments. They were trust itself. But as governments took control of money, detached it from reality, and printed more of it, this ratio became distorted. Every time the system stretched it too far, every time confidence in paper money fell, silver came roaring back. When you study those historical reversions, one thing becomes clear. The correction isn't gradual. It's like a spring that's been wound too tight. Once it releases, it snaps back fast. In 1980, the ratio dropped below 20 to 1. In 2011, it collapsed again as silver shot toward 50D. Both times that happened during moments of fear of inflation, fear of currency debasement, fear that paper promises wouldn't hold. We are standing on that edge again today. The setup is eerily similar. Central banks are cornered. Debt is exploding. Inflation isn't going away. It's just being redefined. The system is fragile. And when people feel that fragility, they flee to hard assets. But here's the twist. Most investors run first to gold. It's the headline metal, the safe haven, the old reliable. Silver, on the other hand, lags until the crowd realizes it's the better bargain. And when that realization hits, the rotation begins and the ratio starts collapsing. This is where the opportunity lies. When everyone else is chasing what's already run, the real wealth is built by those who move early, quietly, before the reversion becomes obvious. That's how the smart money operates. They don't wait for confirmation from CNBC. They understand that history rewards courage and punishes hesitation. Now, think about what a reversion to 30 to 1 really means. If gold holds steady around current levels, silver has to more than double, maybe triple to restore balance. That's not fantasy. That's math. The only question is timing, and history teaches us that once the cycle begins, it moves faster than anyone expects. So when you look at that ratio today, don't see a number, see a story, one of manipulation, imbalance, and inevitable correction. The market always finds equilibrium. It may take time, but it always returns. And when it does, those who understood history won't just survive the correction. They'll profit from it, because wealth isn't built by following trends. It's built by recognizing when the pendulum has swung too far and being ready when it swings back. The markets are whispering a message most people aren't hearing yet. The gold to silver ratio is starting to crack quietly at first, then faster as silver begins to claw its way back into the spotlight. What's happening right now is more than just numbers on a chart. It's a shift in confidence, a change in narrative, a signal that the old balance between gold and silver is breaking down. Momentum is building, and this is how major wealth transfers begin slowly, then all at once. For years, silver has been the neglected metal. It's been the underdog, the forgotten store of value buried under waves of digital money and speculative noise. Investors love to talk about gold, its central bank holdings, its history, its prestige, but silver, that was the cheap cousin. It didn't have the same shine in the media or in portfolios, but the truth is that's exactly what made it dangerous for anyone ignoring it. When something valuable stays cheap for too long while the fundamentals tighten, it doesn't just rise, it explodes. Look at the ratio's recent behavior. Not long ago, It touched levels that were absurd by historical standards, over 90 to 1, even brushing 100 to 1. That kind of divergence doesn't last forever. It's a rubber band stretch to breaking point. And now we're watching it snap back. The ratio has started to fall. Silver's price is firming. And for the first time in years, the momentum is shifting in favor of the metal that still works for a living. This isn't a random market move. It's driven by a series of fundamental forces that are converging. Silver's industrial demand is soaring. Electric vehicles, solar energy, electronics, 5G AI infrastructure, all of these technologies require silver. You can't print silver. You can't fabricate it out of thin air, and you can't replace it with a substitute that performs as efficiently. Meanwhile, supply growth is lagging. Mining companies have been underinvesting for years because low prices discourage new exploration. The result, a tightening physical market, shrinking inventories, and rising premiums on real deliverable silver. While silver's story is getting stronger, gold's momentum is slowing. That doesn't mean gold is weak. It means it's already priced in. Central banks have been buying gold like there's no tomorrow, and institutions have loaded up. That's why gold sits near all-time highs, but silver hasn't caught up yet. The spread between the two metals has reached an emotional extreme, and markets don't like emotional extremes. They correct them. That's what the ratio collapse represents. Emotion giving way to reality. Momentum in markets is psychological before it's financial. At first, nobody believes the shift. Then a few smart investors notice the early signs, higher lows on silver charts, supply shortages, increasing industrial bids. They start accumulating quietly as prices move up. More traders join in. Suddenly, headlines appear. Retail investors notice. ETFs attract inflows. The energy builds. That's how momentum forms from disbelief to acceptance, and finally to mania. We're somewhere between disbelief and acceptance right now, and that's the most profitable stage, to be early. There's another side to this, the fear factor. As the ratio drops, traders holding gold-heavy positions start to rebalance. They sell some gold, buy silver, and that rotation accelerates the move further. It's a feedback loop. Once the market recognizes a trend, it feeds on itself. And when silver starts outperforming gold in percentage terms, which it already is, the headlines will change from silver lagging to silver surging. That's when momentum becomes unstoppable, at least for a while. This is not a random rally. It's a structural revaluation. It's the market recalibrating what real value looks like after years of distortion. The printing presses, the manipulated interest rates, the speculative bubbles, they all push the ratio to unnatural levels. Now the pendulum is swinging back toward balance. The smart move isn't to chase it later when everyone's talking about it. It's to recognize that this is the inflection point. Every major wealth shift in history started with a few people paying attention while the rest were distracted. The gold to silver ratio collapsing isn't just a statistic. It's the market sending a message. The era of passive watching is over. The next big move has already begun. And those who see it early will be the ones writing the story when it's over. When you start understanding real assets, you realize silver isn't just a precious metal. It's the foundation of the future. People talk about gold as wealth, and that's true, but silver is wealth in motion. It's the metal that keeps the modern world running, and that's exactly why it's about to become one of the most strategically valuable assets on Earth. Every major technological revolution, from energy to computing, runs through silver. The difference now is that the world is demanding more of it than ever before, and the supply just isn't keeping up. That's not a theory, that's a setup. Silver's biggest strength isn't just that it's a store of value, it's that it's both money and utility. It conducts electricity better than any other element. It reflects light more efficiently than anything else. It's antibacterial, durable, and essential in the devices that shape our daily lives. Every smartphone, every laptop, every satellite, every solar panel, they all depend on silver. You can't build the future without it. And here's the irony. While people are chasing digital currencies and speculative tech stocks, the very materials that power those technologies are being ignored. That's how markets miss the truth. They get distracted by trends and forget the fundamentals. We're living in an age where the world is shifting gears from fossil fuels to renewables, from analog to digital, from human-driven systems to automated intelligence. That transformation requires energy efficiency, and energy efficiency requires silver. Take solar panels, for example. Every photovoltaic cell uses silver paste to conduct electricity. As governments worldwide push for green energy targets, solar demand is surging. Even small percentage increases in silver use per panel translate into massive tonnage requirements globally. Analysts are warning that by the end of this decade, silver demand from the solar industry alone could exceed total annual mine supply. That's not a projection. That's a wake-up call. Then there's the electric vehicle revolution. Every EV uses roughly twice as much silver as a traditional combustion car because of the complex wiring, sensors, and battery systems. Now, multiply that by tens of millions of vehicles expected to roll off assembly lines each year. Add to that 5G networks, robotics, artificial intelligence hardware, and military technology, all of which rely on silver's unique conductive and reflective properties. You start to see the picture. We're entering a period where the world's appetite for silver is exponential, not linear. But here's the kicker. The supply side of the equation is broken. Silver mining is not a standalone business for most producers. It's a byproduct of mining other metals like lead, zinc, and copper. That means even if silver prices rise, new production doesn't automatically surge because the economics depend on those base metals markets. On top of that, years of underinvestment, environmental restrictions, and resource depletion have limited fresh exploration. The result, the available physical supply is tightening. Inventories are dropping above ground silver. The stuff that's actually deliverable is being consumed faster than it's being replenished. This mismatch between industrial demand and limited supply is the kind of imbalance that builds fortunes for those who can see it before the crowd. The irony is that while the world debates inflation, interest rates, and stock market trends, a silent revolution is forming in the metals that power the real economy. This isn't about paper wealth. It's about tangible assets tied to production, innovation, and survival. When you connect the dots, it becomes obvious silver isn't just another commodity. It's a strategic resource. The more the world digitizes, electrifies, and goes green, the more silver becomes indispensable. And when something becomes indispensable while being scarce, the market doesn't just adjust, it revalues it. That's what's coming. So when you hear talk about silver's industrial role, don't think of it as background noise. Think of it as the heartbeat of the next economic cycle. The world runs on technology. Technology runs on electricity, and electricity runs through silver. That's not speculation. That's physics. And physics doesn't care about politics, forecasts, or central banks. It just tells the truth. And the truth is silver's demand curve is turning vertical while its supply curve stays flat. In that kind of setup, you don't wait for confirmation. You prepare for inevitability. Every time central banks intervene in the economy, they distort reality, they print money, manipulate interest rates, and call it stability. But what they're really doing is inflating illusions and pushing real value further underground. That's why the smartest investors don't watch central bankers. They watch what happens to gold and silver, because metals don't lie. They don't yield to speeches or promises. They tell you in real time how much faith the world actually has in the system. And right now, that faith is cracking. Central banks have backed themselves into a corner. Decades of easy money, low interest rates, and endless debt expansion created a monster they can no longer control. Every time they try to fix one problem, they create another, raise rates, and they crush their own bond markets, lower rates, and inflation explodes again. It's a lose-lose situation. They've destroyed the very foundation of trust in paper currency, and deep down, they know it. That's why they're buying gold like there's no tomorrow. They understand what's coming. When central banks hoard gold, it's not just an investment strategy, it's self-preservation. They're preparing for the day their paper promises lose credibility. But here's where it gets interesting. While the world watches gold, silver quietly waits in the shadows. It doesn't have the same institutional buyers yet, but that's precisely why it's explosive. Because when the panic deepens, when investors realize gold has already run too far and too fast, silver becomes the next refuge. Historically, that's what always happens when the monetary tide shifts. Silver plays catch up, and it does so violently. Monetary policy today is a balancing act on a wire that's fraying at both ends. Inflation isn't under control. It's being redefined. The official numbers might say prices are cooling, but anyone who buys groceries, pays rent, or fills a gas tank knows better. The system is losing purchasing power and currencies are bleeding value slowly day after day. That's why physical assets, especially precious metals, rise in cycles of monetary dishonesty. They don't inflate because they change. They inflate because the currency measuring them gets weaker. In the end, this isn't about interest rates or economic forecasts. It's about confidence. Every major monetary collapse in history followed the same pattern: over leverage, denial, intervention, and finally loss of trust. We're already deep in the denial stage. The only question now is how fast the loss of trust spreads. When it does, gold will be the first responder, but silver will be the accelerator, because silver represents the people's money, the affordable, liquid, real form of value that can't be printed away. That's why every central bank policy announcement should be seen for what it is: a signal that the more they manipulate, the more they reveal how fragile their system truly is. And when that fragility finally breaks into the open, metals won't just rise, they'll reset the definition of value itself. Every great opportunity carries risk, and every crisis hides a strategy. The problem is most people can't tell the difference between the two. They chase what's already gone up and they panic when prices fall. That's not investing, that's reacting. Real investors know timing isn't about luck. It's about awareness. It's about reading the signals that the masses ignore and acting before emotion takes over. When it comes to gold and silver, the same principle applies. The ratio collapsing isn't just a chart pattern. It's a once-in-a-decade setup that requires patience, courage, and clarity. The first rule of any strategy is understanding the cycle. Precious metals move in long, powerful waves. Fear drives them up. Complacency drags them down. The key isn't to predict the exact top or bottom. It's to recognize when the sentiment shifts. Right now, that shift is happening. You can feel it in the tone of the markets. Uncertainty about currencies, distrust in governments, and fatigue from endless financial manipulation. These are not random emotions. They are early signals of a coming monetary storm. Silver, being smaller and more volatile than gold, always reacts harder when the tide turns. That's both the risk and the reward. If you're waiting for a perfect entry, you'll miss it. Perfection is paralysis. The real game is positioning, building gradually, averaging smartly, and holding strong when volatility tries to shake you out. The markets are designed to test conviction. Every pullback, every correction, every headline about the end of the rally is meant to scare weak hands into selling their strength to those with patience. Timing, therefore, is not about guessing the moment. It's about staying in the game long enough to let the fundamentals win. Risk management is what separates gamblers from investors. You don't go all in on emotion. You allocate with intention. You build exposure to silver while it's still unloved, while everyone is distracted by shiny tech stocks or speculative bubbles. Because once the crowd sees what you already